Stop scrolling. This REIT is paying 5.4% dividends. But is it a bargain or a ticking time bomb? If you're a Singapore investor hunting for income, this is one video you do not want to skip. We're breaking down Suntec REIT, the malls, the towers, the payout, the debt, and whether it's a smart buy right now. So smash that like button so more Singaporeans can watch this too. And if you're serious about growing your wealth slowly but surely, hit subscribe to Wealth for You, where we keep investing simple and income steady. Stick around till the end, because I'll be sharing whether Suntec REIT is still worth buying or just a high-yield trap. Disclaimer: this video is for educational and entertainment purposes only. It is not financial advice. All opinions expressed are personal and do not constitute a recommendation to buy or sell any investment. Always do your own due diligence, speak to a qualified advisor, and make decisions based on your individual risk profile. Chapter 1. What's a REIT? First things first. If you're new to REITs, REIT stands for Real Estate Investment Trust. It's kind of like a stock, but instead of selling products, REITs collect rental income from properties like shopping malls, office buildings, or data centers. And by law, Singapore REITs have to pay out at least 90% of their income to investors. So you get regular dividends just like a landlord, but without the leaky toilets. Yeah, that's a plus. Chapter 2. Suntec REIT Overview. Alright, let's dive into what exactly Suntec REIT owns and why it matters. They've got a solid mix of 10 properties spread across Singapore, Australia, and the UK, giving them a nice blend of local strength and overseas diversification. In Singapore, they're anchored by some of the most iconic addresses, Suntec City, which includes offices, one of Singapore's largest malls, and the convention centre, One Raffles Quay and Marina Bay Financial Centre, right in the CBD. In Australia, they've got prime office towers in Sydney, Melbourne, and Adelaide, though we'll talk more about that Adelaide one in a bit. And in the UK, they hold Nova Properties and the Minster Building, both located in central London. So, the total portfolio valuation? A massive 12.2 billion Singapore dollars. Income-wise, it's 73% from office, 24% from retail, and 3% from convention. So yes, they're an office-heavy REIT, but with retail and MICE, that's meetings, incentives, conferences, exhibitions, adding support. Now let's talk occupancy. As of 30th June 2025, Singapore offices are at 99%, practically full. Retail is 98%, also strong. The Australia portfolio is at 88.6%. Not bad, but there's room for improvement. And UK offices are at 92.2%. Pretty solid for London, especially in a cautious market. Not too shabby overall, right? Especially when you're collecting rental income across 3 global markets. Chapter 3. Latest financial performance, ending on 30th of June 2025. So how did Suntec REIT do in the first half of 2025? Well, here's the highlight reel. Distributable income came in at 92.8 million Singapore dollars, which is up 4.6% year-on-year. And DPU, or distribution per unit, rose to 3.155 cents, a 3.7% increase from the same period last year. And the best part? These results came from recurring operations, meaning the REIT didn't need to sell off assets just to pay unit holders. That's the kind of sustainability we love to see. So, what's driving the uptick? First, higher rents from the Singapore office segment. Tenants are still willing to pay top dollar for prime CBD space, and Suntec's got plenty of it. Second, a bounce back in convention activity. More large-scale events and conferences return to Suntec Convention, boosting revenue. And lastly, lower financing costs. Thanks to smart refinancing moves, the REIT managed to reduce its borrowing expenses, which is no small feat in today's interest rate environment. It's a solid performance that shows Suntec REIT still has some muscle, even in a cautious market. Chapter 4. Valuation and Financial Ratios. Now here's where things start to get really interesting. Valuation. Suntec's share price is currently trading at $1.17, but the net asset value per unit is $1.99. That means it's trading at a whopping 41% discount to its book value. That's deep value territory. But before we jump to conclusions, let's look at the rest of the numbers. Key financial metrics. Price to book, or PB, is 0.53 times. You're paying 53 cents on the dollar for assets like CBD offices and London buildings. Sounds like a bargain, right? Price to earnings, or PE, is not applicable. The REIT had negative earnings due to non-cash fair value losses, not because its operations are struggling. So PE isn't meaningful here. Return on equity, or ROE, is 0.08%, basically flat. Why? Again, accounting losses, like property revaluations, drag down the numbers, not poor rental income. Leverage, or debt ratio, is 41.1%. Yes, it's high. REITs are allowed up to 50%, so Suntec still has headroom, but there's not much room to lever up further. Interest coverage ratio, or ICR, is 2.0 times. This tells us Suntec earns twice the amount needed to cover its interest payments, which is a decent buffer, especially in a high-rate environment. So, is Suntec REIT undervalued? Possibly yes. The deep discount to NAV and low PB suggests the market's being cautious, and we'll explore why in the next chapter. But if you're looking through a value investor lens, this might just be worth a closer look. Chapter 5. Dividend History and Sustainability. Let's talk dividends, the part we all look forward to. After all, that's why most of us are looking at REITs in the first place, for steady, passive income. So here are some quick stats. The current yield is 5.44%, and that's based on a forward annual dividend of 6 cents and a share price of $1.17. The payment frequency? Quarterly, like clockwork. Now, if we look back at the past, before 2023, Suntec REIT was paying around 8.8 cents a year, which was pretty solid. But payouts dipped during COVID, and again in 2024, mainly because of higher tax provisions in Australia when they temporarily lost MIT status. For the first half of 2025, DPU stands at 3.155 cents, and honestly, that's a good sign. It's ticking up again and showing signs of recovery. So, is the dividend sustainable? In short, yes, and here's why. It's funded from recurring operating income. That means rent from offices, retail, and convention space. They're not selling off properties just to keep paying investors, which is a common red flag in weaker REITs. Plus, their properties are high quality and located in prime areas like Marina Bay, Raffles Quay, and Central London. These attract solid tenants and command resilient rents. Their operating cash flow comfortably covers the payout, and the management has kept a close eye on costs and interest expenses. So for now, the dividend is not only sustainable, it's showing signs of growth again. But just a small word of caution. Leverage is high at 41.1%. That means they don't have much room to borrow more without risking a downgrade or capital call. So while the dividend is solid for now, any big shocks, like higher interest rates, tenant defaults, or property devaluations, could put future payouts under pressure. That said, if things stay steady or improve, especially with rate cuts coming, more on that soon, the yield looks attractive at these levels. Chapter 6. Future Prospects. So, what's next for Suntec REIT? Well, things might be looking a little brighter on the horizon. The U.S. Federal Reserve has signaled that we could see rate cuts in late 2025 or 2026, and that's music to the ears of REITs like Suntec. Why? because lower interest rates mean lower borrowing costs, which helps ease the pressure from their 41.1% leverage and improves margins over time. On the positive side, Singapore CBD office rents are still holding up well despite global uncertainty. Suntec's key assets like MBFC and One Raffles Quay continue to attract tenants at strong rental rates. Plus, tourism and business travel are steadily returning, which helps support footfall and spending in the Suntec City Mall and drives demand for convention space. Suntec Convention has also been ramping up with more mid to large-scale events, and they're focusing on higher-yielding public sector and corporate bookings. But there are still some watch-outs. The Adelaide property, 55 Curry Street, continues to underperform. Occupancy is just around 52%, and the local market is facing high vacancy along with strong competition from newer developments. Over in the UK, macro uncertainty continues, with interest rates, inflation, and economic growth still bouncing around. While occupancy is decent, lease renewals and rent growth could face pressure. Retail recovery at Suntec Mall has been slower than expected. While occupancy is high, tenant sales and shopper traffic have been a bit flat, reflecting cautious consumer spending in Singapore. Overall, Suntec has a strong foundation in Singapore, and if interest rates start to fall, their cash flow and margins could improve nicely. But they'll need to manage their overseas assets carefully and keep leverage under control to protect that dividend stream. Chapter 7. Verdict. Is it a buy or hold? So here's the bottom line. If you're an income-focused investor looking for a steady 5.4% dividend yield, quarterly payouts you can count on, and exposure to top-tier office buildings in Singapore's CBD, then Suntec REIT could be a solid hold, or even a cautious buy at current prices. The good news? It's trading at a 41% discount to NAV. That's huge for a REIT with quality real estate. It's not overpaying dividends. DPU is fully backed by recurring operations. Singapore, which makes up 70% of its income, is still performing very well. But don't ignore the risks. The REIT is heavily leveraged. At 41.1%, there's not much room to borrow more. Some assets, like 55 Curry Street in Adelaide, are dragging down performance. And macro uncertainty in the UK and soft retail sales in Suntec Mall may continue to weigh on recovery. Backing up the truck and loading up big? Not quite la. A gradual accumulation strategy could make sense, picking up small positions to enjoy passive income while waiting for interest rates to fall and retail traffic to improve. So for now, hold if it's already in your portfolio, and if not, it's worth putting on your watch list and considering a gradual entry, especially if you're in it for the yield, not the thrill. So what do you think? Is Suntec REIT a hidden gem or a value trap in disguise? Drop your thoughts in the comments. I'd love to hear what you're doing with this one. If you found this video helpful, give a thumbs up and hit that subscribe button to join us here at Wealth for You, where we make Singapore REITs and dividend investing easy to understand. And don't forget to tap the notification bell so you'll be the first to know when our next passive income idea drops. Until next time, invest smart, stay chill, and let your money work harder than you do.